how to use debt to make money, how to use debt to grow your wealth, and the differences between good debt and bad debt. Let's use this as an illustration of a property. This is one of my RV and boat storage companies, RV Vault. So let's let this identify a property. So let's say that we're gonna go through and we're gonna purchase a property, and let's use a flat example. We're gonna minimize, but let's say it was $1,000. So 100, 200, 300, 400, 500, 600, 700, 800, 900, 1,000. So what we're gonna do is we're gonna swap the property for $1,000. Now the $1,000 goes to the seller and we are left with the property. Now let's also set some ground rules. So let's say that this property produces, let's say $200 a year in income. So we have 20, 40, 60, 80, 100, 120, 140, 160, 180, 200, okay? Now, out of that, let's say that $80 goes towards expenses. So we got to pay property taxes, insurance, employees, and utilities. All that money is gone, right? So at the end of the day, we're left with $120, right? So if we were to do this ourselves without debt, then we would just have, at the end of the day, we spent $1,000 to buy the property and we're left with $120 at the end of the day. This represents a 12% return. All of this money we would keep, we would take it to the bank. It is our cash flow for the year. And also in commercial real estate, this $120 represents our NOI, our net operating income. Okay, but let's do a quick little reset. Let's say instead of this situation, let's reset, right? So we still have the $1,000 here, but let's say instead of putting down the $1,000 ourselves and all cash, instead we get $900, let's call this the bank money, and then we put in $100 ourselves. This is our money, okay? So the seller still gets the $1,000, but only $100 is coming from us and $900 is coming from the bank, okay? So let's do this swap. We're still gonna swap just like this. We get the property, we only put $100 of our own money in, and we put $900 of the bank money in, okay? So again, the property is gonna be the exact same. We're still gonna produce $200 a year, 160, 180, 200. We still gotta pay property taxes, insurance, utilities, and employees, and we're left with $120, okay? So that went out to expenses. We put $100 in, the bank put $900 in. Now the difference is, guys, is that we have to pay the bank, okay? So we were left with $120, that's our NOI. We still have that money, but now we have to pay the bank, right? The bank's money was over here. So we're gonna pay the bank $40 on their $900 that they lent us, and we're gonna be left over with $80. So last time, in the first example, what happened is we put all the money in and we kept all $120. But in this example, we only put $100 in and we kept $80. So what we did here is we leveraged the bank's money. We didn't make as much overall money. We made $80 instead of the $120, but we earned an 80% return on our money instead of just having a 12% return if we didn't use the bank. Now, out of that $40 that we sent the bank, that's also gonna pay down the $900 that we have to give them whenever we wanna sell this property. Okay, so there's another way that we're making money when we're using debt is not only are we increasing the returns for the money that we have in our own pocket, but we're also paying down the mortgage balance every time we make a payment to the bank, which is every single month. And that's how you can use debt to make money, because what this allows us to do, let's put this in a bigger context. Let's say it's $1 million property. Well, if you didn't have the $1 million just to give to the seller, but you did have $100,000, that's how you can use debt to make money, is you can get into projects, real estate properties that you couldn't have otherwise afforded to get into. And so that's why I think that the rich look at debt as a tool to make money instead of something that can bring them down, simply explained with dollars. With that being said, let's talk about the difference between good debt and bad debt. This is like, you're thinking, Hayden, come on, I know I shouldn't go buy, TVs with debt, vacations that I can't afford with debt. That's obvious bad debt. Let's talk about some other kind of bad debt, okay? Say the $1,000 purchase of that property you were doing. Well, what would happen if the NOI on it wasn't wasn't $120, what would happen if the NOI on that was $30? Well, guess what? Then after we paid the $40 to the bank, we would be losing money. And therefore that debt we used to acquire that property, in my book, would be bad debt. And the point I'm trying to make here is that it all depends deal by deal whether debt is good or whether debt is bad. So just a general rule, I learned this from Robert Kiyosaki, Rich Dad Poor Dad. I talk about it in this book. And what I talk about there is how good debt makes money for you consistently. It's not a, oh, I hope this works out. That kind of like being going and buying stocks on a credit card with the hope that, you know, the stock appreciates, the stock goes up in value. Good debt is when I can go buy a property that has consistent revenue, has a consistently positive NOI, and goes above and beyond that. And one way that you can kind of check to make sure whether you have good debt or bad debt is making sure you have a DSCR, stands for debt service coverage ratio, above a 1. Now, if you don't know what DSCR is, I have a video on my channel that is super helpful, one of my most popular videos. I'll link that in the top right corner right now. You should definitely check that one out. Good debt can also be a refinance. So let's use the same example of the $1,000 property that produced $200 in income, $80 in operating expenses, and we borrowed $900 from the bank. Well, let's say after we purchase it, the property goes from $1,000 of value. Let's say it goes up to $1,500 of value, because let's say we took the income from $200 to $240, right? Let's say that we had a 20% increase. Let's say our expenses stayed the same. That would all go to the NOI. The extra $40, our NOI would move from $120 up to $160. Well, we're still paying the bank the same thing. The properties become more valuable. We have more NOI to pay for our debt service. So what we're gonna do is we're gonna go back to the banker and say, hey banker, the property is now worth $1,500, we owe you $900. How about you give us an extra $300 of debt, and that'll change our payments from $40 a year to, let's just say, $60 a year. Let's say you get a higher interest rate and the payment is proportionally gonna go up. Well, guess what? You can pull that money out, that extra $300 out. It's now debt. Your property still pays for it, and now you can go have that $300. You could go do the same kind of project 3 more times, where you buy a $1,000 property and you put $100 down. In my book, as long as that property is still covering the increased debt service, the mortgage payments, whatever you want to call it, from the refinance, you've still acquired good debt. And that's the name of the game. Buying properties, adding revenue, refinancing the money out, and repeating that process into multiple more properties, and using that good debt via refinance to go do this playbook again and again and again. And that's how you build massive wealth in real estate investing, is through acquiring good debt to go buy more and more properties. And that's how you do it in a shorter amount of time, rather than saving up that money again and again and again. If you haven't liked the video, please do it. Subscribe to the channel. Grab the books if you haven't already. I wish you nothing but the best in your journey to financial freedom through real estate investing. I'm here to support, and I'll see you in the next video.